Welcome to the Deep Dive, your shortcut to being well-informed. In a world absolutely drowning in information, we're here to help you cut through the noise and get to those aha moments that make you truly knowledgeable.
Right, there's just so much out there.
Exactly. So today we're doing something a bit different, a deep dive into the 2014 annual report from a company called Markel.
Markel, yeah, an interesting choice.
Now you might be thinking, an annual report? Really? But honestly, this isn't just about crunching numbers.
Not at all. These things can be gold mines.
It's a treasure trove of enduring business wisdom, and we've also brought in some thought-provoking questions about investing in business, just to, frame our discussion.
Good idea. Context is everything.
Our mission here is to pull out the most important nuggets of knowledge and insight. We want to show how Markel approaches growth, culture, and capital allocation with this really distinct long-term mindset. We'll show you how a company like this navigates change, how they set themselves up for decades of success, and why understanding their approach can genuinely inform your own thinking. Whether you're an investor, a business owner, or just, curious about how great companies actually operate.
Sounds good. It's true, a shareholder letter, often tucked away in that report, can give you this incredibly unique window into a company's soul. Sometimes reveals more than the quarterly earnings calls.
That's a great point. Okay, let's unpack this thing.
What Markel lays out here isn't just a review of the year, it's more like a blueprint for building lasting value.
And they really set that tone from the very first line, don't they?
Yeah.
Addressing shareholders directly as owners.
Yeah, saying, this is your company, you own it, and we work for you. That's quite direct.
How does that framing, that specific language, set a different tone compared to maybe other companies? What does it tell us about their philosophy?
Well, it's foundational, really. It immediately shifts the relationship from just a transactional investor to more of a committed partner.
Partner. Interesting.
Right. It implies this fiduciary duty, this commitment to long-term value creation, not just next quarter's results. It frames the whole thing as a shared journey.
And their big goal? They state it right out there.
They do, explicitly. To build one of the world's great companies. And they're clear on how they measure that success. It's two things.
Which are?
Outstanding long-term financial results, and D, an enduring culture that attracts the best associates, customers, and shareholders. So it's not just about the money.
It's the whole package, the foundation, the people.
Exactly. And that culture piece is key.
And it speaks to a legacy too, right? They mention having 3 generations of family ownership and over 3 decades of public ownership.
Yeah, that signals a deep-rooted, patient approach. This isn't some flash-in-the-pan strategy they cooked up. It's built over decades.
Okay, let's zoom in on 2014 itself. They call it a watershed year, where their people went from a sprint to hyperspeed. That sounds pretty dynamic.
It does. It suggests adaptability, even for a company focused on the long haul.
So what were the key financial takeaways from that specific year? Did the numbers back up the hyperspeed idea?
Well, financially, 2014 was definitely a strong year for them. Total revenues grew 19% to $5.1 billion. That's up from $4.3 billion the year before.
Pretty significant jump.
Yeah. And in their core insurance operations, gross written premiums hit $4.8 billion, up from $3.9 billion. Plus, their combined ratio was 95%.
Okay, remind us what that means again. Lower is it better? Right.
Right. It means for every dollar of premium they took in, they spent 95 cents on claims and expenses. So profitable. And it was actually an improvement from 97% in 2013, meaning the new business was more profitable too.
Got it. And how about their investments?
Their investment portfolio did well too, earned 7.4% overall. Equities were strong, up 18.6%, and fixed income returned 6.5%.
And Markel Ventures, we should probably talk more about that later, but how did it do in 2014?
Ventures also had a good year. Revenues grew to $838.1 million, and adjusted EBITDA, which is a decent measure of operational profit, hit $95.1 million.
Wow. So across the board, insurance, investments, ventures, things were clicking, and the stock price
reflected that. It rose 18% during the year, from about $580 to $682. So yeah, pretty impressive numbers for a single year.
But here's where it gets interesting, right? Despite those great numbers.
Exactly. The powerful insight here is Markel's relentless focus on long-term averages, not just short-term spikes. They explicitly say, right in the report, that results from any single year do not reliably describe the real accomplishments.
That seems counterintuitive in today's world.
It does, but they understand that an annual snapshot, no matter how good it looks, can be really misleading. That's a crucial lesson, I think, for anyone evaluating performance, business, personal finance, whatever.
Such an important point. So if they believe single-year results can mislead, how do they actually, internally measure performance? How do they set up incentives?
They use a system. Mechanically, they use a rolling 5-year measurement period for things like incentive compensation.
5 years. Okay.
Yeah. And it's not just a preference. They genuinely believe this gives them a huge advantage because it forces everyone to focus on the long-term goals, not just the next 12 months.
So they build it right into how people get paid.
Precisely. And the lesson for us, maybe, is that if you embed those long-term metrics directly into reward systems in business or even personal goals, you naturally shift focus away from those short-term pressures. It fosters, genuine resilience and sustainable progress.
And when you look at their 5-year results in the report, it really does put 2014 in perspective.
Absolutely. Over 5 years, revenues grew 148% from $2.1 billion to that $5.1 billion book value per share,
Right.
up 93% from around $282 to $543.
That's huge compounding.
It is. And comprehensive income, basically total profit including investment gains, was $2.6 billion in those 5 years compared to $1.1 billion in the previous 5 years.
Talk about acceleration. They even quote the Beals in the report.
Yeah. It's getting better all the time. It clearly shows the power of their approach. That consistent, multi-year compounding is what really builds enduring wealth, not just for the company, but for its owners.
Okay, so beyond the 2014 numbers, the report then looks forward, asking what's next. They start that section with a quote from Patrick Henry.
I know of no way of judging the future but by the past. A classic.
But then Markel adds their own spin, saying they believe excellence comes from experimentation rather than design. How do those two ideas fit together? Respect for the past, but belief in experimentation.
It's an interesting mix, isn't it? They seem to use the past as a guide, but not a rigid blueprint. They highlight 4 pivotal decisions, which they actually call experiments, that shaped their recent success.
Experiments, okay?
Yeah. It underlines that while their core values might stay the same, the tools and approaches they use have to keep evolving to deal with a changing world. Adaptability is key.
So what was the first experiment they talk about?
That was the One Markel initiative.
Right. What problem was that trying to solve?
Yeah. Well, historically, Markel grew mainly by buying other companies, but they tended to let those acquired businesses just keep operating as they always had.
Kind of standalone units.
Exactly. Which led to, as they put it, silos of IT systems, marketing channels, and so on. Apparently, a smart investor back in the early 90s pointed out that their approach, while successful up to then, wasn't really scalable.
So they had a collection of good parts, but maybe you weren't getting the full benefit of being one company.
That's the gist. The One Markel initiative was about changing that mindset, shifting from a confederation of individual units into one global company.
A big undertaking.
Huge. They realized that with business speeding up, thanks to IT and globalization, they needed to be faster and more scalable. It touched everything they did and was a real departure from how they used to operate. Shows that adaptability in action.
Makes sense. What was the second pivotal decision or experiment?
That was the Altera acquisition. This was a big one. It roughly doubled the size of the company in one fell swoop, as they say.
Wow, doubled it.
Yeah. And the key thing here was that its sheer size forced immediate dramatic change. There was no room for gradual adjustment. Business as usual just doesn't work when something that big happens.
So it kind of forced their hand, broke any complacency.
Exactly. It challenged that common, if it ain't broke, why fix it? Mentality that can sneak into successful companies sometimes. They had to re-examine everything.
Which leads right into their third decision, how they integrated Altera. You said they used to let acquisitions run independently?
They did, but with Altera, they changed their approach. They integrated it from day one.
A totally different playbook.
Totally. And they believe this new day one mindset led to a smoother integration and ultimately better economics in the long run.
Can you give an example of that?
Sure. They mentioned strengthening Altera's loss reserves immediately to match Markel's more conservative philosophy. Now, doing that penalizes the reported short-term earnings, makes the numbers look worse initially.
But it's the right thing for the long-term health of the business.
Exactly. It reinforces their culture and drives stronger, more reliable results down the road. They also extended their own long-term entrepreneurial incentive pay plans to the Altera folks, which helps cement the Markel style and align everyone's interests.
Smart. Okay, moving to the fourth key experiment. The creation and expansion of Markel Ventures. What exactly is Markel Ventures?
Markel Ventures is basically their collection of non-insurance businesses. It's incredibly diverse, everything from companies making bakery equipment to residential home builders, consulting firms, a real mix.
So completely separate from the insurance side.
Operationally, yes. It started pretty small back in 2005, maybe $60 million in revenue, but by 2014, the year we're focusing on, it had grown to $838 million in revenue and generated $95 million in adjusted EBITDA.
That's serious growth. So what's the strategic purpose? Why run these seemingly unrelated businesses?
It serves a dual purpose, as they explain it. One, it gives them another option for capital allocation decisions. They have another place to potentially invest the company's money besides insurance or stocks.
More flexibility.
Right. And two, as they bluntly put it, it makes a bunch of money. It's become a significant contributor to their overall growth and profitability.
It really sets them apart, doesn't it? They mentioned how most companies are kind of constrained.
Yeah, constrained by needing to reinvest just to stay competitive in their one industry, or having a narrow focus, or dealing with shareholders who only care about the next quarter. Markel sees themselves as different, fueled by imagination and the desire to grow.
That diversification through ventures shows real strategic agility. It's not just an insurance company anymore.
Not by a long shot. It demonstrates a true long-term vision that goes beyond their original core business.
Okay, so all these strategic moves, One Markel, Altera, Ventures, they clearly require resources. This brings us to how Markel decides where to put its money, their capital allocation philosophy.
Right. And they preface this by talking about earning an unusual degree of trust and flexibility from our owners over many decades. That trust is crucial.
Why is that trust so important for capital allocation?
Because it allows them to pursue their distinct, sometimes unconventional strategy without constant second-guessing from the market. It enables their four-step triage approach, as they call it.
Triage. Okay, what's step one?
First priority is organic growth, supporting their existing insurance and Markel Ventures operations, giving capital to their proven, successful operators, basically betting on their own people and businesses first.
Makes sense. What's step two?
Then they look for acquisitions. That could be insurance businesses or non-insurance businesses for ventures anywhere in the world.
Globally.
Yeah, they explicitly say they believe their values and our culture work all around the globe and that talented people want to be part of this company. They're looking for good businesses with good people, and they expect them to exceed our wildest expectations over the long term. It's not just about the entry price. It's about the fit and the future.
Okay, so internal growth first, then acquisitions. What's the third option in their triage?
Publicly traded securities, stocks and bonds. This is where their investment philosophy really comes through.
And they use this four-step equity selection process they've had since 1999.
Exactly. Very consistent. Step one, look for profitable businesses with good returns on capital and not too much debt.
Okay.
Step two, management teams that are both talented and have integrity. That integrity piece is crucial for them.
Can't teach integrity.
You can't. Step three, businesses that have opportunities to reinvest their own profits wisely, or management that is disciplined about returning capital if they don't.
Got it. And step four?
Reasonable valuations. They're not necessarily deep value investors, but they don't want to overpay. It's a blend of quality and price consciousness.
And what about their fixed income, their bonds?
Pretty straightforward there. Focus on high-quality bonds, mainly to support the insurance liabilities.
Yeah.
They try to match the duration and currencies to those liabilities, and they explicitly state they do not attempt to forecast or profit from interest rate or currency movement.
So no big macro bets.
Right. No. It's about protecting the balance sheet, providing stability, not trying to be heroes predicting the Fed. They even say they avoid long-term bonds when yields are too low to justify the risk.
And they manage all this investment stuff in-house very cheaply.
Incredibly cheaply. Single-digit number of basis points is what they claim for costs. And because they tend to buy and hold for the long term, it's also incredibly tax efficient. They're not constantly trading and generating capital gains taxes.
But what really makes them stand out here is how they deliberately ignore investment trends or fashions.
That's a huge part of their identity. They directly take on indexing, for example.
Right. Most people say indexing is the way to go now. Low cost, diversified.
They acknowledge the low-cost goal, but they call indexing a relatively brainless activity that actually distorts market prices because everyone's forced to buy the same big stocks regardless of value.
Ouch. Brainless. Strong words.
Very strong. They contrast their use of brains and common sense with what they saw happen to indexers in the late 90s tech bubble and the subsequent crash. And they point to their own track record being in their third decade of outperforming the S&P 500 at that point.
So they're basically saying, we think we can do better by actively picking good businesses at fair prices. How do they justify that confidence, especially when so many pros underperform?
Their justification stems from their fundamental belief that markets aren't perfectly efficient. They use the example of the oil market in 2014. Prices fell from over $100 a barrel to less than half that in just a few months.
Yeah, that was a wild swing.
They use that volatility to, quote, dismiss those who believe in efficient markets or forecasting just about anything. Their point is, if markets were efficient and predictable, you wouldn't see those kinds of massive, rapid shifts.
So because markets are sometimes irrational or unpredictable,
There are opportunities for thoughtful, long-term investors who focus on fundamentals. Their investment success, they argue, isn't about forecasting oil prices or interest rates. It's about finding the people and financial circumstances who will make the best of whatever happens. It's bottom-up stock picking focused on quality and management.
okay, that makes their stance clearer. So internal growth, acquisitions, public securities.
Yeah.
What's the fourth and final step in their capital allocation triage?
Share repurchases, buying back their own stock.
And that's the last resort.
Definitely the last resort. Only if they think it offers a better return than investing in their existing businesses, buying new ones, or finding good publicly traded securities. They mention they've done modest amounts over the years, but their clear preference is to reinvest capital in growing businesses. Again, it highlights that long-term, growth-oriented mindset.
Okay, so after covering strategy, growth, investments, it's fascinating that they then dedicate a whole section to, as they jokingly call it, the always treasured accounting discussion.
Yeah. They even note that 5 out of the 6 executives signing the letter wish they didn't have to write about accounting.
But they say it's of mortal importance. Why is understanding the accounting so critical to understanding Markel's story?
Because, as they explain, standard accounting rules, especially with complex companies involved in acquisitions and long-term investments, don't always perfectly reflect the underlying economic reality.
Gotcha.
They stress that to really get the picture, you need to look beyond just the balance sheet these days. You have to focus increasingly on the statement of cash flows and our income statement as well.
And they also make a point about the rate of change.
Yes, that the rate of change in book value per share is equally, if not more important than the absolute measure of book value at any single point in time. It's the trajectory, the growth trend, that matters most.
And they give a really great concrete example of this gap versus reality gap with that goodwill impairment charge in Markel Ventures.
That's a perfect illustration. They took a $13.7 million charge for goodwill impairment in Ventures.
Which sounds bad, like that part of the business is in trouble.
Right. But the contradiction is, this happened in a year where Markel Ventures actually earned over $95 million in adjusted EBITDA. It was performing very well overall.
So why the impairment charge then? That seems crazy.
It's down to the accounting rules. GAAP makes them test goodwill for impairment at a specific reporting unit level within Ventures. Maybe one small piece wasn't meeting its original projections, even when the segment overall was thriving. So rules say, take the charge.
Ah, so the accounting rule triggered a negative headline, even though the economic reality of Ventures was positive.
Precisely. And that's the key insight they want shareholders to grasp. Accounting rules are necessary, but they can sometimes obscure the true economic picture. You can't just react to a headline number like impairment charge. You have to dig deeper and understand the economic story.
And they point out it's a one-way street too, right? Goodwill gets written down, but never written back up if things improve.
Exactly. Another quirk, they also briefly touch on, other than temporary impairment, or OTTI, on their public stocks. They took a small $4.5 million charge against net income for that.
Even while the overall equity portfolio earned nearly 19% that year.
Right. It's another case where an accounting rule, marking down a stock believed to be impaired, hits the income statement, even if the overall portfolio is doing great. And importantly, if that markdown stock later recovers, the gain doesn't flow back through the income statement until it's actually sold.
Man, accounting can be confusing. So how do they suggest people cut through this noise?
Their answer comes back to book value. They argued that the net change in book value calculation, which happens on the balance sheet and captures comprehensive income, effectively corrects for these kinds of accounting quirks over time. That's why they hammer home that book value growth is the most important single financial metric for understanding their real economic progress.
And they back this up with data comparing book value growth to stock price growth over long periods.
They do. Compelling data. The 5-year compound annual growth rate, CAGR, in book value per share was 14%, while the stock price CGR was 15%. Very close.
And over 21 years.
Even closer. Book value KGR was 16%, stock price CGR was 15%. They state flat out it is no accident that those numbers are so similar.
Wow.
Their conclusion is that the long-term growth rate of book value per share, while not perfect, is the least worst proxy for predicting the long-term growth in the company's intrinsic value and, ultimately, its stock price. That's a massive insight for long-term investors evaluating any company, not just Markel.
It really ties everything together, the strategy, the investments, the culture, into one core metric they want owners to focus on.
Exactly. It filters out the short-term accounting noise and gives you a clearer view of the underlying economic engine. It's about transparency and aligning everyone on what truly matters for long-term value creation.
So after digging through all the numbers, the strategies, the accounting, that we circle back to where we started, really. The culture.
The foundation.
They mentioned the consistent values as described in the Markel style, which they say makes Markel a wonderful company in which to build a career. This commitment to culture seems like it underpins everything else.
It absolutely does. It's not just fluff. You see it in their future section, too, where they state, "We will dedicate ourselves to learning continuously and we will never stop."
Continuous learning.
Yeah. That's not just a platitude for them, I don't think. It's a deep-seated belief that the soft stuff, the leadership, integrity, creativity, flexibility, adaptability, that's what actually generates those hard numbers over the long haul. The culture is the engine.
And they wrap up their outlook quite simply. More of the same. More, which sounds a bit like complacency at first.
But it isn't, is it? You read the context, and it's clearly not about standing still. It's a commitment to what they call an eternally challenging but magnificent quest of simply getting better all the time.
Ah, okay. So more of the same means sticking to the core philosophy and values.
And the more means constantly improving, adapting, growing, pushing the boundaries within that framework. It's this active, relentless pursuit of continuous improvement built on that strong cultural foundation.
Okay, so let's try to wrap this up. What are the big takeaways from this deep dive into Markel's 2014 report?
Well, for me, it's seeing a company with just this unwavering long-term vision. That's number one.
Right, and coupled with that, a real strategic adaptability. They're willing to experiment, like with One Markel or Ventures.
Definitely. Then there's their disciplined, almost unconventional approach to capital allocation and investing, ignoring fads, focusing on value and management.
And finally, their transparency, even around tricky stuff like accounting, trying to help owners understand the real economic picture.
Exactly. And the key thing is, these aren't just interesting details about one company in one specific year. They feel like timeless principles.
Principles for anyone navigating this, constantly changing world filled with information overload.
Precisely. The real value for you listening isn't just learning about Markel, but understanding how a successful, enduring enterprise thinks, adapts, and prioritizes genuine long-term value over short-term appearances.
That Markel phrase, more of the same, more, that constant quest to get better, it makes you think. For you listening, what does getting better all the time look like in your own life or work?
Good question.
And maybe, what's just one commitment you could make today to start on that magnificent quest, as they call it, of continuous learning and adaptation? It's about embracing that long game, isn't it? Even if it sometimes means, metaphorically, taking charges in the short term for the sake of enduring success down the road.
Well said. Thinking long-term, even when it's hard.
Thank you for joining us on the Deep Dive. We hope this exploration of Markel's thinking has given you some fresh perspectives and maybe some valuable insights to carry forward.
Hope so. Until next time.
Until next time, keep digging.